Welcome back into my Vanguard portfolio update. This is the final one of 2025. I can't believe we're already saying that. I'll have a look at the markets, how they've been doing. We'll dive into the news, and also finally we'll look at my portfolio to see how it's performed over the whole year and see exactly what I've bought and how much I've put in. Starting with the S&P 500, let's have a look on screen now. You can see it's had quite a roller coaster over the past 30 days. From the height it set earlier, you can see it fell more than 4.5%. Now it's all back up at the moment, setting some new all-time highs, at least as I make this video. Now, just last month, the index was down 0.4% in November, making it the worst performance for a month since 2021. And a lot of people were definitely worried and certainly considered the fact that the AI bubble was here and everything was going to crash down. So far, that hasn't played out. Doesn't mean it can't in the future. And we've still got a few weeks left before the end of the year, but quite a wild ride that investors have to go through in really a short space of time. Now that might be based in dollars when we have a look at the S&P 500 chart there, but let me just get a UK pound denominated S&P 500 index fund. And you'll actually see that you've performed quite poorly over the past month. And that's because the pound has actually strengthened against the dollar. So effectively, when the pound gets stronger, you're able to buy your US investments a little bit cheaper. But then when you come to sell them, or when it comes to actually value them and look at them in your account, it will appear like they're less valuable. So this is always a thing you have to balance when you're a UK investor and you look at charts like this of the S&P 500, then you look at your investing account and you think, well, what's gone on? And really, it's all down to exchange rates of the pound and the dollar. Over the very long term, I personally don't pay too much attention to it, but in the short term, it's what causes these big swings. And hopefully on the way out, as well as you sell, whether that's over many, many years and decades, you're just going to get a long-term average, but it's still very important to know what's going on. Now, closer to home, the FTSE 100, which has had a great year, which we'll show in just a moment. Have a look here how it's been performing over the past month. So not quite at those all-time highs that it had set. However, you can see that actually the UK stock market's been performing pretty well. If we just expand out now, just going over the past year, you can see that actually the FTSE 100 has done really, really well. And also, if you consider what it's done from a total return impact as well. Remember when you're searching on Google or the chart of the FTSE 100, this doesn't include any dividends, and the FTSE 100 is quite a dividend-heavy index. If you include those, the total return so far, just over the past year for the FTSE 100, is over 20%, at least at the time of making this video. So overall, a pretty good year, although we do have a few weeks left. If you want to have a look at what you guys predict to happen in 2026, I did make a video which I just published a couple of days ago, so have a look at that, where I asked all of you what you thought might happen to the S&P 500, to the FTSE 100, and also UK interest rates as we head into 2026. Okay, going into news now, I think this whole AI bubble, AI risk and reward play is still very much top of investors' minds at the moment. You can see the market is still near those all-time highs and just about to set a new one at the moment, but there has been quite a lot of consolidation over the past couple of months, especially after that dip in November. Things haven't just been going up every single day, and we have seen things level out a little bit in some parts of the market. Many investors are still hoping for this Santa rally. Now, this is what happens when the stock market rises over the last week or so, 7 to 10 days worth of the trading window, just as we head before Christmas, and also a couple of days into the new year. Typically, the whole idea behind this is that people are optimistic, excited about the holidays, etc. So they also put their money into the stock market too. And most of the time it has worked out well. If you have a look at some of the stats on it, there is quite a lot of data to back this up. It doesn't mean, of course, that this is the year that it's definitely going to go up. However, if you have a look here, for example, you can see it's gone up 1.3% since the 1950s, and 75 to 80% of the time, we do get a Santa rally in the last few days of December. However, that does not mean it has to happen this year. The past did not determine what will happen in the future, but it's really interesting to see what happens here. Maybe it's one of those things that are self-reinforcing. So because everyone knows and expects it's going to happen, they also follow that too and put their money in the markets at the end of the year. Now, sticking on this topic of AI, there's been quite a lot of AI news stories coming out, especially from the Magnificent Seven, all of those big technology stocks based in the US. You can see here Google actually shooting up at the moment. It's actually become the best performing stock in the Magnificent Seven over the past year, which is quite interesting because there was a part of this year, I remember covering it on this show, and I spoke about the fact that Google was a bit down in the dumps, it was a bit unloved, as many people were saying that its whole business model was going to get eaten alive by AI and ChatGPT and all these kind of things. You had analysts on screen now saying Google was finished, but actually it's been the best performing stock of the past year, if you have a look at it from a year-to-date perspective. Now, one of the reasons for that is this news story here, as you can see here. Companies like Anthropic and Meta are buying up Google's TPUs, which are different from what NVIDIA sells. NVIDIA sell GPUs, but they're designed to perform very specific tasks when it comes to generative AI. And Google is seen here as the leader in this space. So lots of people putting their money into Google and not just sending it all to NVIDIA to buy GPUs. Now, this, of course, have got lots of people very, very much excited about Google's potential here. And it's actually shot the stock up, as I've just mentioned. Now, sticking with those big tech stocks, Meta announced they were cutting spending in their metaverse division by about 30%. This headline actually sent the stock price going up quite nicely, as investors were worried that this is one of the areas of their business where they were spending a big fortune, but actually not getting many returns. Now, this doesn't mean that they're going to stop spending money in other areas. They might take this money and put it over into their AI spending. There's some huge capital expenditures going on when it comes to what Meta are doing in the AI space. But the metaverse is one of those bets that hasn't really paid off. I got very, very excited that we would all be wearing virtual reality goggles and augmented reality stuff by now, which could happen at some point in the future. But I think we might be quite a long way off from that one. So I think this bet is going to slowly slide into oblivion. And finally, on the Mag 7, this week we saw this weird headline come out which sent the market into a bit of a tiz, and then it did recover a little bit, basically saying that Microsoft suggesting that they were cutting their sales quota for some of their AI products, which is mainly Copilot. And this was coming from a couple of insiders in Microsoft's sales cloud division, but then it was denied by Microsoft, who came out and said this isn't true at all. They've mixed up what they were trying to sell. So people were slightly worried that Microsoft, although they've invested heavily into AI, aren't actually selling these products or making any money from it. A lot of their big enterprise customers are sticking with the traditional Office 365 subscription, and they're not happy with this big uplift for Copilot. From memory, I think it's actually quite a big uplift per seat. I think it's like $30 or $60 a month. I can't remember the exact amount, but it's quite a lot. And I don't think a lot of people are really using Copilot. If you work in a business and you're using it every day, do let me know in the comment section below. In other wider news in the US, some jobs growth data is suggesting that ultimately the Federal Reserve is going to have to come and save the day and cut those interest rates. Job growth has slowed. More and more people are finding it harder to find work. So to stimulate the economy, as the Federal Reserve has that dual mandate to keep inflation under control, but also keep the job market under control too, we're looking very likely to get a cut from the Federal Reserve very soon. Just like the UK Bank of England, which I'll talk about later, this would then put the rate from around 4%, where it is now, to 3.75%. So they will meet very soon later this month. So we'll see what happens if that actually comes to fruition. Okay, going back closer to home now, the UK, I think the biggest story from the past month was the UK budget that was delivered by Rachel Reeves. The budget that was the most anticipated, most leaked budget I think we've ever known in our lifetimes. Every single policy decision was leaked over the past few months and years, and everything finally came out, so we don't have to worry about stressing over that. Really, it was a story of tax, and more tax over lots of little things, rather than touching some of the big tax generators in the UK, which are income tax, VAT, and national insurance. Now, I did do a video on my channel covering these in more detail, so feel free to go back and have a look at my budget review of 2025. However, if you want some of the headlines from that, really the big story was about fiscal drag. So the income tax bans being frozen for another few years does mean that more and more people are going to be pulled into paying taxes at those higher and additional tax rates. People in jobs which aren't necessarily right up there being highly paid will find themselves paying more and more of their money in these higher tax bands. Also, we had other changes, like a couple of P being put onto dividends taxes, and also savings interest allowances as well. So although savings allowances didn't change, the amount of tax you would pay on your savings interest did go up as well. And there were big changes to ISA accounts too. Now, these changes aren't going to come in until April 2027. And funny enough, quite a lot of the changes in these budgets were kicked quite far down the road, much closer to the next election. Now, to me, that says that I don't think they really know how they're going to administer a lot of these. The whole thought process behind this was, as the government want more people to invest their money rather than save it into cash ISAs, they will cut the cash ISA allowance, and therefore they just hope by magic of osmosis that that money finds itself into stocks and shares ISAs. However, the real issue stopping people investing, when you actually look at the research and data behind this, is that people just don't know how to do it. They lack a lot of confidence in it. They worry that they're going to lose money when it comes to investing. Most people have no idea what the stock market is, how to invest in it, how to do it safely, and the idea of investing long-term, dollar cost averaging, all of those kinds of things. So the idea of cutting the cash allowance to force people to invest is an incredibly stupid short-term move. And I honestly don't even think this will make the light of day, but we'll see what happens in April 2027. I think this could be another idea like the British ISA, which as soon as that was announced, I made a video and I said it wouldn't even see the light of day because I thought it was just a stupid idea. We need to stop making ISAs more complicated, stop making more and more products, and just make these things simpler and help people understand how to invest in the first place, which is one thing I try and do in my entire mission on this channel. Now, on that same topic, another news story I saw from the UK, which interests me quite a lot, was the amount of money that investors were pulling out of the market in the months leading up to the budget. These are enormous sums. Basically, investors were taking way more money out of their investments than they were putting back in. So there was a net loss to lots and lots of different providers, all really leading up to this budget, as lots of people thought their pension tax-free cash allowance, for example, was going to be completely stopped. Now, thankfully, since the budget, things are reversed and money now is flowing back in, but billions and billions of pounds flew out the door into people's cash and low-cost products like money market funds, for example, and cash savings accounts, all because of the mess of this budget. Now, funnily enough, the tax-free allowance from pensions and lifetime allowance, none of that was actually touched. The only thing that was touched in pensions was how much you could actually salary sacrifice before you would have to pay the national insurance on that contribution. So that's going to be limited to £2,000. But unfortunately, lots of people react to all these leaks and they make decisions based on things which aren't set in stone. I think it's a really poor and really stupid way of doing things. I really think we should stop making decisions based on things which could happen and rumours, but lots of people were scared. Don't really blame them. They were worried they might be able to not take out their tax-free cash, so lots of people are taking that out now, and that's a decision they can't reverse. Once you take out money from your pension as tax-free lump sum, you can't put it back in, unfortunately, so we are where we are. And finally, from a UK tax perspective, this might be welcome news to lots of people, especially if you have a mortgage or you want to get out a loan for something and you're looking for asset prices to increase as well. The Bank of England, I think, is very highly likely to cut rates as we head into the final meeting of the year. It was really close in their last meeting in November. I think it was a 5-4 decision, basically to keep rates at 4%. We're looking now, likely, at least the markets are baking in, a cut down to 3.75%. However, as with anything, it's not set in stone yet, so we'll just have to wait and see for the next Bank of England Monetary Committee meeting taking place in December. Okay, time to actually have a look at the portfolio now. I'll show you exactly what I've done this month, and we'll have a bit of a review on everything that's been going on in the year so far. So just for everyone who's new around here, this is my Vanguard account, and it's just one of many investing accounts I have. Now, the only thing I have here is my self-invested personal pension. So my ISAs are on other platforms. They were trading 212 and Invest Engine. I don't hold spare cash here, for example, or anything like that. I don't hold my business cash here. This is just for my self-invested personal pension. Now, what I did over the years, I basically put all of my workplace pensions, my old workplace pensions, into this. And then I've also added money as we go over the most recent years from my current limited company. So every single month I try and put in as much as I can. I really try and max out that pension allowance if I can. And really I want to grow this over the next few decades. So if I just go into the investments tab now, you can see total value of the account is £145,069.69p, two sets of 69, giggity. I put everything into a simple global index fund, so many regular viewers will know this one. This is the FTSE Global All Cap Index Fund, the accumulation version. Basically invest in companies all over the world. I don't get paid any dividends, everything just gets reinvested. Super nice and simple, gives me a really nice diversification across the world. And it also just means I can switch my brain off when it comes to investing in my SIP. I view the SIP and the pension as a little bit different from your ISAs. Remember, with ISAs, you can take money out anytime you like. With pensions, these things are something you can't take out until you reach retirement age, which by 2028 will be 57, if you want to actually take money out of private pensions like self-invested personal pensions. So as someone who's 37 now, I've basically got 20 years to try and build up this pot and get as much money in as possible. Now, as usual, as we start the month, I put money in. I've gone for £5,000 this month from my business. And I've done this rather than putting in 4,000, which I had been regularly. If I put in 5,000, I've worked out that I'll be able to maximise the pension by the end of the financial year. So as we go before April the 6th, I'll be able to maximise what I've put in to the pension. So this is why you see some of the money changing, different amounts. Also, remember I covered last month basically saying the reason I put in this £10,000 was my company financial year ended in the end of October. So I normally try and go a regular amount into my pension, but obviously I'm trying to be tax efficient too. Putting your money into pensions is a really good tax efficient way to use money from your business, because it's just like any other business expense. It's completely allowable, which means that ultimately you save all of your corporation tax, and also you save all the money that you would have paid personally on personal income tax, whether that would be through dividends tax. So if you combine dividend tax with corporation tax, you're looking at least a 28% saving, 30+% saving. And if you're a higher rate taxpayer, even more as well. So pensions are extremely tax efficient. Let's have a look over the past year how things have performed month by month. I think it's a really interesting story. I can't believe we're at the end of 2025 already, and I remember some of the months very well, as many of you will do as well. So look, we started the year everything completely on a high. Everyone's still quite euphoric. You can see here in January 2025, the investments returned good amount of money, another £2,500 return there. However, this is when things started getting interesting, and the story of the day was Trump's tariffs. So February, March and April, all negative months. If you remember, the stock market actually dipped to its lowest point in April, and many people thought it could go further. There were some huge reactions to the market, and this actually put the cumulative returns in the account down to quite a measly £10,000, having all of this money in the account. However, at no point did I ever think about changing my investment strategy or changing things. I do fear that a lot of people did that, unfortunately, and changed their minds and moved money around. And unfortunately, there'll always be people who will convince themselves they can time the market, or just people who are ignorant and really new to investing too, thinking that you just pull your money out and then you just wait for the dip and you put your money back in. It's all that easy. If it was that easy, we'd all be multi-millionaires, and no one can do it regardless of whether you're a professional or whether you're an amateur investor. And no matter how much you try and convince yourself otherwise, there'll be plenty of people watching this who will be convinced that they can do that. Good luck to you. Anyway, after all that mess, we had a bit of a spring-summer rally, as basically the tariffs turned out to be something which were basically just rolled back on every single time. So May, June, July, both amazing months. August was okay. September, really good. October, amazing. November, where we had that dip, not so good. December, so far, on the investment returns, not amazing. However, this is just so far as we're looking at the account. I think there's a good potential that these things could change. Remember, also playing a big part of this, as I mentioned earlier, is going to be that exchange rate. So in a global index fund, most of your money is going to be in stocks which are denominated in US dollars. So as the pound strengthens, your investment return looks worse. Although actually, when I'm buying them at the moment, when you're buying the investments, you can view it, if you would like, as a bit of a discount. That, of course, does assume that the exchange rate will change the other way. But I really don't pay attention too much to it. But however, that's one thing to pay attention to if you want to understand what's going on. The S&P 500 could rally 5%, for example, in dollar terms, but the exchange rate could change 5%, and actually your returns could show zero. So you're probably wondering what's going on. Now, as we head into 2026, I'm going to make a bit of a wider video about all of my investment accounts and my 2026 investing plan. I did a similar video last year and it was really well received. I think lots of people like to understand all of the different accounts, how they interact, what I'm doing and why I'm doing it as well. Remember, I'm not a financial advisor, but I think it does help to have someone who explains why they're doing things they are, sharing their own journey. Not enough people are transparent about all their investments, and they'll hide certain things and they won't tell you exactly what they're doing. So look out for that video coming in the new year. Let me know how you're getting on as well in the comment section below, and I will see you in the next video. As always, happy investing.